Okay, so a little bit motivated by the trading game we played last week, I thought I'd say a few words about what we know about how ordinary people like us trade stocks in our portfolios. So academic researchers have done a pretty good job over the past 20 years of getting hold of large databases on how people like us trade stocks. And we've learned a lot from these databases, and in particular we've learned that people often make mistakes when they trade stocks. And I wanted to talk about a couple of these mistakes: excessive trading and the disposition effect. So first of all, excessive trading, which is really about some sense that when people trade stocks, they trade too much. So here's a famous example. Here's a well-known study which analyzes data on about 80,000 households trading stocks through a large discount brokerage firm in the early 1990s. And the famous finding in this study is that the average return of the individual investors trading through this brokerage after transaction costs is well below a range of passive benchmarks like the S&P 500. And there's a picture on the next page, I think, that shows you that. So look at this second black column from the right. This shows you the average return of the typical household trading through this brokerage firm after transaction costs. And the rightmost black column here shows you the average return after transaction cost of a passive benchmark like the S&P 500. And what you can see is the typical household underperforms the passive benchmarks. The average return after transaction costs is lower. And by the way, the people who trade the most do the worst. So if you look at the left-hand side, the researchers have put people into 5 buckets depending on how much you trade, ranging from those who trade the least through to those who trade the most. And if you track the black columns from left to right, these are the average returns after transaction costs, you can see a dramatic decline in portfolio return the more you trade. And by the way, why is this happening? You could have poor returns for one of 2 reasons. It could be because of poor security selection. You just buy stocks that go down. Or it could be because of transaction costs. By trading, you incur transaction costs which drag down your performance. This is mainly the result of the second factor. These returns are low because by trading a lot, people incur transaction costs which drags down their returns. So this picture is really a puzzle. People seem to be trading too much. By trading, they're lowering their returns. It seems they would do better if they just traded a lot less. So someone like me from the behavioral finance group would want to leap to the conclusion that people are being irrational here. And there are psychological factors that are driving this irrationality. And in about 3 minutes, I will leap to that conclusion. But just before we get there, let's try and be a little bit more serious and sort of think, could we give any rational explanations for what's going on in this picture? And maybe it might be good to structure it with a question, which is, this picture aside, what are the rational, sensible reasons for buying or selling a stock? I mean, many of us buy or sell stocks, right? Presumably there are sensible reasons to do so. So information, does that explain what's going on in the picture? No. Because if people have information, they're going to beat the market. But they don't, they lose to it. I mean, they may think they have information, but they clearly do not. Right? So that's not explaining what's going on. Liquidity, that could be partly explaining this, right? So the idea, the story would be, I have to sell stocks because I need the money. I know I'm going to incur transaction costs which will lower my return, but there's nothing I can do about it. I just need the money. So that could be going on. I don't find it fully plausible because if you knew you were going to need the money, then you probably wouldn't park it in high transaction cost individual stocks. You would probably put it in a lower transaction cost stock index, something like that. So maybe I find it a little implausible. Suzanne said taxes, and I think that could be partly going on. Probably people are selling stocks at a loss to realize a loss that they can then use to offset gains elsewhere. But that's certainly not the only kind of trading we're seeing here. So I don't see that as a full explanation. Frankly, the best one on this list might be entertainment. So the idea is, yeah, I'm trading and I know I'm losing money, but it's okay, I'm having fun, right? That's the idea behind this story. And I think that probably is going on to some extent. The only thing I would say about it is, I mean, some of these accounts are pretty large, right? So it's hard to believe that people are entertaining themselves with their life savings, right? That doesn't, quite make sense. But, maybe I'll put a question mark. Anyway, the thing I'm trying to suggest is it's hard to explain this picture on rational grounds, and so I feel justified moving to a more behavioral finance explanation, one that says that this behavior is driven in part by irrational thinking, it's psychologically motivated. And the psychological bias that has been most associated with trading is overconfidence. So overconfidence is one of the most famous psychological biases. It has many manifestations, but one of the main ones is that people tend to have excessively rosy views of their abilities and prospects. Right? So the kind of thing where in surveys, 80 to 90% of people think that they're above average on things like attractiveness or sense of humor or ability to get along with people or driving ability, things like that. And obviously a large fraction are deluding themselves. Okay? That's overconfidence. So you understand how that could explain the picture, right? The story would be, I know that the average household underperforms the indices, but I'm better than average, so I'm just going to go ahead and trade, right? But because I'm overconfident, I end up losing to the passive benchmarks as well. That's the story. Now, I don't want to leave that just as a hypothesis. Let's be scientific about this and actually test the hypothesis. Let's think about what new predictions it would make and test them. So a very natural prediction of this hypothesis is that more overconfident people should trade more, right? And so there have been some very nice tests of this idea recently, and I wanted to mention one of my favorites. It's done using data from Finland. So a number of these studies use data from Sweden or Finland. These countries keep very close records of what their citizens do, so it's a good place to do these studies. And it turns out that at the age of 19, every Finnish male has to go into the military, and when you do, you have to take a bunch of psychological and aptitude tests. Okay? And one of the psychological tests is a self-reported measure of confidence. How confident a person are you on a scale of 1 to 10? And so the measure of overconfidence in this study is your self-reported confidence minus how confident you should be based on your performance in the aptitude tests. Right? So it's cruel, but good. Okay? There's a measure of overconfidence measured at the age of 19, and the amazing result in this study is that that measure of overconfidence measured at 19 predicts how frequently you trade stocks in your brokerage account several years later when you open one. And so to me, that's nice evidence for the overconfidence view of what's happening in that picture. By the way, another simple prediction is this. The psychology literature is very clear. Men are more overconfident than women. And so right away we predict that men will trade more and will have lower average returns. Okay? And unfortunately for men, that's very true in the data. Men trade more and they have lower average returns. And by the way, a number of people have commented that it's probably very hard to understand the huge volume of trading we see on world stock markets as a consequence of purely rational behavior. That to understand why we see the amount of trading that we do, we probably need to invoke some psychological biases like overconfidence. The story, roughly speaking, is this. If everyone was fully rational, you would see relatively little trading, right? Because if I go to buy a stock and you're willing to sell, I should say, wait, why are you willing to sell? You must know something bad, so I'm not going to buy at all in the first place. Right? It sounds extreme, but that's how a fully rational person will think. As a result, you won't see that much trading in a fully rational economy. So to explain the vast amounts of trading we actually see, we may need to invoke something like overconfidence. So the logic is, I go to buy a stock and you're willing to sell. So then I say, oh, okay, you think the stock's going to go down, but I think I'm much better than you at analyzing stocks, because I'm overconfident, right? And so I go ahead and trade regardless. So it may be that we need something like overconfidence to explain the massive amounts of trading that we actually see. Let me turn to the second main mistake we've learnt about from these data. It's something interesting called the disposition effect, which is a very simple fact. It's just the fact that we individuals, when we sell a stock in our portfolio, we tend to sell a stock that has gone up in value since we bought it, rather than a stock that has gone down in value since we bought it. And that might sound very natural to you. You probably do that. I do it too. But it's now widely viewed as a mistake. And perhaps the simplest way to see why it's a mistake is because of a phenomenon that we'll actually talk more about next week called momentum, which is strongly present in the stock market, but also in most other asset classes as well, the bond market, currencies, commodities, and so on. And what is it? It simply says that stocks that have gone up in the past few months tend to keep going up after that, and stocks that have declined in the past few months tend to keep going down after that. That's momentum. So what is the right way to trade in the presence of momentum? Well, notice what you would want to do is to hold on to stocks that have recently done well so as to capture the continued increase after that, and to sell stocks that have recently done poorly so as to avoid the subsequent decline. In other words, you should sell loser stocks pretty often, but the winner stocks more rarely. But people actually do exactly the opposite. So what is the actual behavior we observe in markets? So if I just put this back up on the board, what do people actually do? They tend to sell stocks that have recently gone up in value, and they tend to hold on to stocks that have recently gone down. In other words, they tend to sell winner stocks more often than they sell loser stocks. But that is a mistake, as you can see, because by selling the winner stocks, you are losing out on this subsequent price increase, and by holding on to the losers, you are being punished by the subsequent decline.